Good evening, everyone, and welcome to another exciting IQI Canada Evening Talk. It is that time of the month again, my last Mondays when we look at the economic outlook and see what's happening around in the world. And, for that particular show, I have none other than our chief economist, Shan Saeed. Good morning to you, Shan. How are you doing?
Good morning, Yousaf. Thank you for having me in your show again.
Thank you so much, Sean. Doing a live at 6 o'clock, 7 o'clock in the morning. I really appreciate that. And before we begin, Sean, happy birthday to you. I know it was 17th of November, but we didn't have an opportunity to wish you live on our shows of wishing you a very, very happy birthday and many, many more years to come.
Thank you, Yousaf. Thank you very much. I'm grateful to you and to IQI. They've made a very elaborate arrangement. Thank you to Kashif, Nabil, Shahid, Sheila, Daniel. Vinny arranged make a very good cake for me. So it was very touching and, a very good gesture. So I really liked it.
Amazing. You know what? That's the amazing part. At Juwai IQI, and when we say family, it means a family. And as you rightly mentioned, the act of doing this is more because we are a big happy family, and we make sure that we're taking care of each other on that. Sean, we are coming towards the almost the end of the year, and next time when you and I talk, we'll be talking almost towards the last, in December, which is going to be our last show for the year of 2021. A lot has happened in the market right now. We've been seeing so many things happening right now. And what I've got a few questions for you lined up, and if you're ready to start, I'll start with my first question.
Yes, and plus, I would like to congratulate you and your team for opening the fourth branch in Canada, taking into account that 3 years back we only had one branch. So,
That's
this demonstrates that IQI has done, Juwai IQI has done a very good job and, in penetrating the market and giving good service to its valued clients so that clients can come back to us and they have reposed trust in you and your team for getting strategic insight about the real estate market in Toronto, Mississauga, Calgary, Vancouver, Cambridge, Markham. So all this shows that you have done an excellent job and you are taking IQI to the new level of global excellence.
Thank you very much, Sean. It's always, the teamwork. And of course, as, I would say the people behind us who've been pushing me, Kashif, Daniel, again, Sheila, Nabil, yourself, there has been always been so many factors, from our side who's been motivating us and pushing us on that. So thank you very much for that. We are very excited to serve our clients on the east end, which is going to be towards the Markham, the Richmond Hill branch. So now we're able to cover up a larger sector of the area. We have, our team is really amazing. I would say all our IQ warriors, our family members, always ready to serve our clients on that. So yes, thank you so much. Anybody's looking for any sort of real estate need, contact IQI Canada. So let's get started with our questions, Sean. What's
Yes.
happening in the equity market? It's a turmoil, chaos, and backline in the equity markets. 2.7 trillion wiped off in the equity markets in one day alone. Collapse in confidence leads to 1970 style of stagflation. What's your view on the market outlook?
Yes, Yusuf, last Friday was a total bedlam. And as you rightly pointed out, just in one day alone, investors lost $2.7 trillion. So that shows that the market is so fragile and investors are so nervous that they don't really know how to position themselves. So in this turbulent market, it's very difficult to predict the outlook of equity and bond markets. And that's why we have witnessed that more and more valued, sophisticated, and smart investors are going into tangible assets. And we have seen that real estate is still a very important asset class for many investors who are looking at their portfolio for next year. and they are now thinking that since the red flags are up, the new virus is coming into the market, how they're going to position themselves. So I think equity and bond markets will continue to stay volatile. The reason is very simple. You have two systematic risks. One is the inflation risk, which is very real and which is happening right now. And we have been sharing with our valued investors since November 2020. And the second systematic risk is the interest rates going up, which eventually would become inevitable next year, maybe by Q2 or Q3 next year. But the way things are shaping up, central banks are getting serious because inflation is getting stubborn. And once inflation gets stubborn, then the policy makers, they have to think about it from a longer perspective. And once the interest rates will go up, obviously it will have a huge impact on the equity and bond market. And the way bond market is shaping up, the yields are going up. And year end, we have been saying the 10-year US Treasury would be trading between 155 and 165. And right now, when I speak to you, the 10-year yield is trading at 1.51. And for next year, we are expecting yield to go up between 2.5 and 3%. So obviously there is a lot of chaos, bedlam. Investors are nervous, and some of the investors, they have actually started pulling their funds out of the equity and the bond market. Bond is the worst asset class. We have been discussing a person like Warren Buffett, who is sitting on $150 billion. He's not taking position in bond market because your income is 1.5, your inflation is 6%, so you're already in negatives. You're not making money in the bond market. Equities, yes, investors have made money last year and this year as well, but still investors are nervous once the interest rates will go up. So I think there will be chaos. Equity market will stay uncertain. Fragility is the key in this market. So only way to protect yourself is to go into tangible asset. So as you rightly pointed out, I foresee more and more investors losing funds in equity and bond markets, and they will pull out, and they will eventually go to the uh, tangible asset class, which was the norm in 1970, as most of the investors, they made money in real estate, gold, and silver. So I think we are heading for the same era after 52 years. 1970 era is back. Tangible assets will hold the key. Economist magazine in September issue shared a full detail how investors position themselves in the 1970 era, and the main proposition in that era was real estate, commodities, and the mainland, the farmland investment for many investors.
Great. And also we have a couple of, we'll just come back to this talk for the prices as well on that, share another one. So this was one of the other things we saw. Ricardo says that, 41 billion was wiped off the both of the Australian share market, huh?
Yes, absolutely. Just in Australia alone, I was sitting somewhere 3 p.m. in the afternoon, and 41 billion wiped off from the Australian equity market. So that is huge.
That's true. That's true. So coming to my second question now, economics. Well, before I do that, let's say hi to a couple of people who joined us. So, hey, Sarah, thank you so much for joining us, Sarah Irfan.
Good morning.
And hey, Ardovan, thank you for joining us as well. Really
Good morning.
appreciate you guys joining us. So my second question is that Economist magazine risk metric outlook for 2022 mentions 10 major risks. One of the risks that I remember is what if an unexpectedly fast monetary tightening leads to a US stock market crash? Shan, I'm observing the markets very closely, especially the bond market. Correct me if I'm wrong or right, but I could foresee an asset flip. Equities have become bonds and bonds have become equities. Sean, can you hear me?
Yes, you shared with you, and
Sean, can you hear me? Sean, we're getting a little loose connection. Hey, Sean. All right, I think because Sean lost his connection due to some technical error, he should be joining us very, very quickly. Till he's coming in, we're going to say hi to Kashif. Thank you, Kashif. We got Sean back
Sorry,
here. Hey,
I
Sean.
think there was a
That's okay.
breakdown of.
That's okay. That's okay. A little bit technical issues are always there.
Sorry,
Uh, no
can
worries.
you
No
hear me now?
worries. I can hear you. I can hear you.
I was telling you that higher interest rates would become inevitable. Once the interest rates would go up, it will create chaos, especially in the equity and bond market. And the challenge is most of the investors, they don't really hedge themselves against these risks. And one, this risk will become, it will enter into the market that will create a huge bedlam. So I think what Economist magazine is saying is very much pragmatic. We are expecting that maybe by Q2, Q3, that interest rate will go up next year. And once the interest rate will go up, it will have a squeeze on the earnings of many companies. And once you have squeeze, your share market, your share prices will go down. It will have impact on your cash flow, and eventually market capitalization of many companies will go down. So I think that is a huge risk that is coming into the market. And nervous and panicky tightening of monetary policy is one of those risks that investors are expecting. And central banks right now, some of the central banks like ECB in Europe, Fed in US, they are really panicking and they don't know how to control this runaway inflation.
Great. Thank you, Sean. Let's go and say hi to a couple of people who joined us. Kashif Ansari, your group CEO. Salam, Yousaf and Shan. Walaikum Salam, Shah. Kashif,
Islam.
thank you for joining us. And Lily, all the way from Australia. Good morning, Lily. Thank you so much for joining us.
Good
Really
morning.
appreciate it. So, coming back to my third question, inflation is back. According to Goldman Sachs, inflation will get worse before it gets better. I know that since I've read your post on LinkedIn that inflation in USA is badly hitting the consumers. Beef is up by 44%, gasoline is up by 51%, used cars are up by 26%. Furniture bedding up by 11%, vehicle rentals up by 39%, eggs are up by 12%. Natural gas up by 28%, and the list is big, and the inflation is getting out of the roof. So why did the Fed say that inflation was transitory, and you said inflation stubborn since May 2021?
If you recall, Yusuf, in February, the inflation was 2.4%,
Yeah,
and now it is 6.2%.
yeah,
So it has gone up by 2.5 times. So since May, Kashif and I, we have been discussing this, that is it transitory? And I have been saying that this is stubborn and inflation is getting serious. And once inflation gets serious, it gets out of control. As you rightly pointed out, inflation is getting out of roof. And this is where consumers are suffering. Look at, eggs are up by 12%, beef is up 24%, used vehicles are up 24%, 39%. All these things, are going up. So once inflation goes up, why inflation is going up? Because the velocity of money, the turnover of money has gone up because people are getting money from the government. Every month people are getting uh, 500 to $1,000 from the government. So that gives an opportunity for consumers to spend. And as you know, if you look at US GDP size, 70% of the consumption comes from the consumers. The GDP consists of 70% through the consumption. So that is the key, and the government wants people to spend money. And once people keep on spending money, that's where the momentum generates. But how long? Once the stimulus goes back and government is not giving money, how people are going to survive? And in the last 2 years, uh, average consumption on grocery shopping has gone up from $100 to $200. So example is, if I go to Walmart right now, the minimum that I have to spend is around $200. The grocery items that I purchase for my monthly uh, household. It's not $100 anymore. 2 years back, or maybe 3 years back, you can survive in $100. Not anymore. So I think inflation is getting serious, and this inflation will continue to rise for the next 12 to 18 months. And once it slows down, then it will give some room for consumers to to have some breathing space, and the inflation will go down.
So you're expecting
Excuse
it
me.
to continue to grow up for next 12 to 18 months as well, the inflation?
Yes, inflation will continue to go up for the
Hmm.
next 12 to 18 months because this lower interest rate regime will continue. And if there is any red flag, we have red flag that is Omicron is a red flag. Nobody expected this virus to come.
Yeah.
And because of this virus, we expect global economy to slow down. Once the global economy slows down, that gives an excuse to central banks like ECB, Bank of England, and Fed not to raise interest rate. So for the next 6 months, I don't see the interest rates going up, but maybe by end of Q2 or Q3, we expect uh, interest rates to go up. Once interest rates go up, yes, it will create a serious bedlam and pandemonium and uncertainty in the market, and a lot of people will suffer.
No, that's right. But you're expecting the interest rate. That was actually one of my questions as well, which you just now covered. So we're looking at the interest rates to go up around, you're saying quarter two and quarter three. That's why we can see the interest
By
rates to go up.
Q2 or Q3 next year. But again,
Hmm.
it depends on the global outlook. We expect
Hmm.
global outlook to remain fragile. There
Okay.
will be a lot of fragility in the system. And once you have the fragility, a global economy can't take the pressure of higher interest rate. Yes, inflation is good for short run, but long
That's
run,
right.
obviously, the living standard your goes down, your purchasing power goes down because of higher inflation, and eventually central banks will intervene in the market to curb the rising inflation, and that's where the systematic risk comes into play.
Hmm. Okay. Excellent. So my other question is that, your favorite topic, which is the oil market, it's gone down by 11 to 12% in the last 4 days, again, due to the emergence of the Omicron variant. And you shared in our monthly newsletter that the oil prices will stay between 77 and 107 barrel in 2022. Where do you see next 2 to 3 months? Is it more, volatility with geostrategic risk is in the market amid variant challenges? Or can you please share your insight about the oil market? What's exactly going to happen?
Yes, Yusuf, as you rightly pointed out, oil has gone down by 12% in the last 4 days, and I expect oil prices to stay volatile for the next 2 to 3 months. But I still stick to my call that I have shared not only in press and media but also in my newsletter: 77 to $107 per barrel next year. But surprisingly, yesterday, you can share with your listeners, JP Morgan is saying $120.
Yes.
JP Morgan is saying in 2023 it could go even beyond $120 per
Yeah.
barrel.
Yeah.
So imagine we are people think that Shan is very bold. So what JP Morgan is saying is even higher. Is saying 120 and $150.
That's right.
So why is that? Because there is a supply constraint, and the risk of supply constraint, because global economy is might shut down again in the next 2 to 3 months, but the oil demand is there. How are you going
Yeah.
to move ships? How are you going to move planes? How are you going to do transportation? Supply chain is becoming a big headache for many companies. So how you are going to move your supply chain? How are you going to move your economy? So you need oil and gas. Your life and my life, it depends purely on oil and gas. So
That's right.
oil, people were saying, oh, we will have another swing in the market, and market will go down to $50 and $40. I said, how can you say that? Because the break even for many companies, let's talk about Saudi Arabia, they need
Yeah,
$80 per barrel to balance their budget.
that's
Russia
right.
needs $55 to $58 to balance and to make a break even. For American shale gas companies, the break even is between 48 and 54. So how you're going to survive when oil prices go below $50? They can't. Then many companies will file for Chapter 11 bankruptcy, and they can't survive in these challenging times when you have new virus come into the market. So obviously there will be supply constraint in the market. And what JB Morgan is saying is very pragmatic. And right now when I speak, I was looking at tradingeconomics.com. Oil is still trading at $73, so it's picking up. As of yesterday, it went up to $76 per barrel. It went up 4%, but it's still trading at $73. So that is fine. But for H2, from July till December, we have already shared in a market. Oil prices will stay between 73 and $87 per barrel by 31st December this year. So I think it's in line with our forecast. And for next year, yes, oil prices will stay above $80 per barrel. And many companies will not increase their capex. They will only increase their capex if oil stays above $80 per barrel. So we are expecting the capex in the energy market to hover between 100 to $150 billion for the next 2 years. And once oil prices will go up 120 or $130 per barrel, then we can expect the capex will go up. So yes, oil market is very volatile for the next 2-3 months. Nobody knows how the global economy will pan out. And once this virus outlook, the guidance from WHO, World Health Organization,
Yeah.
then companies and economies will decide how they're going to strategize in terms of the energy requirement, in terms of the energy outlook. So next 2-3 months, yes, it should stay volatile between 65 to $85 per barrel. Once it stabilizes at around $80 per barrel, then we can expect oil prices to go higher from there. So next 2-3 months, yes, there will be a lot of volatility in the energy market. Global economy will slow down, and the policy makers will have a lot of headache how to strategize, how to come up with economic policy, how to come up with economic framework in order to move ahead and in order to maintain macroeconomic stability, so that economic confidence it comes back into the macro picture.
Thank you so much for the insight. And you rightly said, I was looking at the JP Morgan report as well, where they're talking about $150, going from $80 to $150 on that. So yeah, we probably will see a lot of, changes, and we'll see how things go. But as you rightly said, we're always on top of the things. I would say that, your insights towards the oil market, the bond market, or the interest rates have been always, in line, and have been great, of what's going on in the market on that. So we're going to say hi to Bob Zoo. Hey, Bob, thanks for joining us. You know,
Good
Bob
morning.
is the Bob is our VP operations for the Markham office, the fourth branch you were talking about, which we opened up. Hey, Bob, thanks for joining in. So finally, Economist magazine said Toronto is the safest cities in the world. I was reading that article which said it's one of the safest cities in the world. What do you say about that?
Oh, yes, I was pleasantly surprised that Toronto is not number one, because most of my friends, including you, we have always shared that Toronto is very safe. The education facilities are world class. The healthcare facilities are world class. People enjoy living in Canada because the branding is so strong. When you talk about Canada, people think they're in a first class country, brilliant healthcare facilities, brilliant job environment, higher per capita income, higher living standard. So Canada has really marketed herself very nicely. So when people they look at Toronto or Calgary or Vancouver or Ottawa or Mississauga, all these places, they have very high class living. And people, why do they move to Canada? Because of lifestyle, because of luxury living. because it has got a certain image. So the image is so strong that everyone's first choice is Canada, and then they go to Australia, and then they go to Malaysia and Singapore and UK and other places. But in terms of safety and security, yes, that has become a prime concern because the global economy is slowing down, and when the economies are in recession, that's where the crime rate goes up. Like in US, I have lived in Chicago and New York. The crime rates are up because a lot of people, they have challenging times, especially in terms of economics. And you only fight when your stomach is empty. You don't fight when your stomach is full. So when people are going through a lot of hardships, they resort to crimes and other bad things, and that is very challenging for uh, in terms of social norms of the country, how to provide employment to all, to uplift the living standard of many people. So I think what Canada has done in terms of living standard, in terms of maintaining stability, it's all about stability, macroeconomic stability in the country. That's why you were saying that in the next 1 to 2 years you're expecting 1.2 million immigrants coming into the country.
That's
So
right.
what do they need? The first thing they need is housing. The
Yeah.
second is education. The third is healthcare facilities. And why are these 1.2 million people moving to Canada? Because of macroeconomic stability. And everybody has got access to reports. And once they read these reports from Economist magazine, from Wall Street, Sunday's Financial Times, when it markets all the properties in Toronto, Mississauga. So when those sophisticated and smart investors, they look at Canada, they say, "Oh, 1.2 million people, there must be something." So it's all about the living standard, the luxury, the lifestyle. So, in my opinion, when people, they're moving to Canada, 1.2 million, it's all about they want to acquire, they want to achieve a certain lifestyle, not only for themselves but also for the children, for the future generation, so that they can have a better living for the next 20 to 25, 30 years.
You're absolutely right. Spot on, Sean. I always say that, Canada was always in the radar of people moving in for the same reasons which you said, safety, education, healthcare, the lifestyle, the standard of living. And during pandemic, Canada has marketed itself, knowingly or unknowingly very well as one of the safest, cities, safest countries in the world. And, we do see a lot more in terms of the immigrants coming in. Talking about the housing part, the real estate prices have gone up and still continue to grow up. One of the reasons is that exactly what you pointed out is because of the influx of population and the immigrants coming in this country. During the time of pandemic, yes, we've seen maybe in other parts of the world the real estate prices have gone up. But when I talk especially about the Toronto Real Estate Board or the Ontario GTA side, we're looking at an increase of about like 25 to 27% in terms of the price increases on that, which is quite quite high what we have seen there, and the demand continues to be there. So very, normally you would say in, being in real estate during this time of the year, November, December, people used to say, oh, you know what, things started getting slowing down in real estate. People will say a lot of people not going to move out, or there's a lot of not moving in, not a lot of properties will go on sale. It's Christmas time, all this time, and normally the business would slow down for the realtors. It will slow down for next, from November, December to January, mid-January, February start going up. But for last couple of years or 3 years, I have actually seen that it's actually not slowing down. Whether it is we talk about the resale market, still multiple offers. When we talk about the new projects getting launched up, we'll still see, there's a huge demand for people getting, the new projects as well on that. And again, one of the reasons is that because in terms of the housing market, there's still a lot more demand and the supply is a bit less. So, from the real estate perspective as well, we see that this will continue to grow. And as you rightly mentioned, the influx of population coming in due to lifestyle, security, education, safety reasons will continue that to see up an upward trend on that. So with this note, thank you so much, Sean. Anything else you want to add up before we say bye to our audience?
I think, in my opinion, next 2 3 months are very crucial for the global economy, and I expect, sovereign wealth funds, the hedge funds, the pension funds, the endowments, they will move out of equity markets, and I would not be surprised if fund managers like Blackstone and BlackRock taking huge position in real estate, not only in Canada, but also in UK, also in Australia, because these fund managers, like, they are huge, they are giant, BlackRock and Blackstone, and endowments like Harvard and Yale, they are moving their portfolio from out of equity and bond market, and they are going into real estate, farmland, and commodities. So once these players they move into these asset classes, that will be a huge signal to the forward guidance for many investors. So I expect these fund managers, endowments, and hedge funds, and pension funds, that they will be reallocating their strategy in terms of 2022 and in terms of 2023. So once these funds move into real estate, then, as we say, real estate is a new global currency. When we wrote this book, when we have written this book, sorry, in 2020, in 2015,
Yeah,
nobody thought that we were serious. People thought they have just come up with a book, but now everybody is getting serious about real estate, and now they have come to realize that, tangible assets hold the key. So tangible assets will hold the key. The markets will continue to get volatile. I don't expect global economy to recover before 2025. So expect volatility in 22, 2023, and 24. The global economy will only recover in 2025. So you know how to hedge yourself against uncertainty, against this bedlam and pandemonium and bloodbath. Go to tangible assets. And investors have a choice: peace of mind or sleepless nights. If you want to have sleepless nights, go to Bitcoin, go to bond market, go to equity market. If you want peace of mind, real estate, gold, silver, oil, arts, yachts, expensive watches. These are the tangible assets that hold value. This is all I have to say. Thank you so much, Yousaf, for having me again. I always enjoy my discourse, my talk. I always call it the smart talk, the strategic talk, so that people who are listening to us, they learn one or two things. If they can pick up one or two things, I think we have done our job in 30, 35 minutes. Thank you so much.
absolutely, absolutely. Thank you very much, Sean. Have a wonderful day, and thank you for all our audience for joining us. This is our monthly economic update, which we do with our chief economist, Shan Saeed. If you want us to cover up a specific topic or any specific questions, please feel free to write down your comments, and Sean and I will try to cover them up in our next evening talk. In the meanwhile, if you have any other questions, do reach out to us. I will be more than happy to help you with your real estate needs, or at the same time, let you know that, where you need to invest, as Sean said, all the tangible assets. Take care of yourself. Thank you so much and have a wonderful day. Bye bye.
Bye bye.